Stablecoins are often called the safest part of the crypto world. They are designed to stay equal to $1 and are widely used for trading, payments, savings, and DeFi applications. Because of this, many people treat them like real digital cash. However, behind this image of stability lies a fragile system that can crack under pressure. Stablecoins depend heavily on trust in reserves, liquidity, and issuer transparency. Recent depegging events have shown that stablecoins are not risk-free, and their failures can shake the entire financial ecosystem. This video is all about the hidden fragility of digital dollars. If you use stablecoins or plan to invest in crypto, understanding these hidden risks is no longer optional. Keep reading to stay informed. Let's get started. What stablecoins really are and what they are not. Stablecoins are digital tokens designed to maintain a fixed value, usually $1. They achieve this by using reserves such as cash, government bonds, or other financial assets. Despite their name, stablecoins are not guaranteed by governments, banks, or central authorities. This makes them very different from traditional money in your bank account. Many users assume stablecoins are as safe as dollars, but in reality, their stability depends entirely on the issuer's financial strength and honesty. Stablecoins function more like private money issued by companies, not sovereign currency. Knowing this difference is crucial to understanding why they can suddenly become unstable. The illusion of perfect stability. The biggest appeal of stablecoins is their promise of price stability. However, this stability is often an illusion created by market confidence rather than guaranteed backing. As long as users believe they can redeem one token for $1, the system works smoothly. The problem starts when doubts arise. Even small rumors about reserve quality or liquidity can cause panic. Once users rush to redeem their tokens, issuers may struggle to meet demand quickly. Stability, in this case, is not built on strong protections, but on continuous trust. When trust disappears, prices can fall rapidly. This shows that stablecoins are only stable when conditions are calm, not when markets are under pressure. Reserve opacity, the black box problem. One of the biggest risks in stablecoins is reserve opacity. Many issuers do not provide clear, real-time information about what backs their tokens. Users often rely on periodic reports that may be outdated, incomplete, or unaudited. Some reserves include risky assets like corporate debt or crypto-linked instruments instead of pure cash. This creates uncertainty during market downturns. If users are unsure whether reserves are safe, panic can spread quickly. Unlike banks, they are not required to meet strict disclosure standards in most regions. This lack of visibility makes it difficult to assess real risk. When transparency is missing, even a small shock can turn into a full-scale crisis. Liquidity stress and redemption pressure. Liquidity is the ability to meet redemptions instantly without selling assets at a loss. Stablecoins face serious liquidity risks during sudden mass withdrawals. If many users try to redeem at once, issuers may need to sell reserves quickly. This can be difficult, especially if reserves include long-term bonds or illiquid assets. Unlike traditional banks, stablecoin issuers usually lack deposit insurance or lender of last resort support. This means there is no safety net when things go wrong. Liquidity stress turns a manageable issue into a systemic threat. Once redemption pressure begins, it can escalate faster than issuers can respond, leading to depegging and market chaos. Depegging events, small cracks, big damage. A depegging event happens when a stablecoin loses its one-to-one value with the dollar. Even a small deviation can have serious consequences. Traders, algorithms, and DeFi protocols react instantly to price changes. This can trigger forced liquidations, smart contract failures, and market crashes. Depegging destroys trust, which is extremely hard to rebuild. Past events have shown that once confidence is lost, users may never fully return. These events also affect other stablecoins as fear spreads across the market. Depegging does not stay isolated, it travels fast. Because stablecoins are deeply connected to exchanges, lending platforms, and payment systems, one failure can impact the entire crypto ecosystem. This makes stablecoins potential points of systemic risk rather than safe anchors of stability. Contagion risk. Across DeFi, stablecoins are the backbone of decentralized finance. They are used as collateral, trading pairs, and settlement assets. When a stablecoin weakens, DeFi protocols feel the shock immediately. Automated systems may liquidate positions, freeze withdrawals, or break price mechanisms. Because DeFi relies heavily on smart contracts, it lacks human judgment during crises. This makes reactions fast and sometimes extreme. One unstable stablecoin can cascade into multiple protocol failures. Users may lose funds even if they did nothing wrong. The interconnected nature of DeFi amplifies risks instead of containing them. This shows that stablecoins are not just individual products, they are system-critical infrastructure. Any weakness in them threatens the entire DeFi ecosystem, making risk management more complex than many users realize. Spillover into traditional markets. Stablecoin risks do not stop at crypto boundaries. Many issuers hold traditional financial assets such as treasury bills and commercial paper. During large redemption events, selling these assets quickly can affect broader markets. This creates spillover risks for traditional finance. Regulators worry that a large stablecoin failure could disrupt short-term funding markets. As stablecoins grow, their influence on real-world liquidity increases. This blurs the line between crypto and traditional finance. A crisis in one space can trigger stress in the other. This interconnectedness raises serious concerns for financial stability. What once seemed like a niche crypto issue is now a potential global risk. Stablecoins are no longer isolated experiments. They are becoming part of the financial system's foundation. Should stablecoin issuers be treated like banks? The growing importance of stablecoins has sparked a major regulatory debate. Many experts argue that stablecoin issuers perform bank-like functions without bank-level oversight. They take funds, promise stability, and manage reserves, just like banks. However, they often operate under lighter regulations. This regulatory gap creates risk for users and the broader system. Treating stablecoin issuers like banks would mean stricter capital requirements, audits, and liquidity rules. While this could reduce innovation speed, it would greatly improve safety. What users and investors should watch closely. Users should not treat all stablecoins as equal. Key factors to watch include reserve quality, transparency, audit frequency, and redemption mechanisms. Understanding how a stablecoin maintains its peg is essential. Avoid relying solely on brand names or popularity. Diversification can also reduce exposure to a single failure. Investors should pay attention to regulatory developments and market signals. Sudden changes in liquidity or pricing often signal deeper issues. Education is the first line of defense against risk. Stablecoins can be useful tools, but blind trust can be costly. Informed users make better decisions and help create healthier markets. Awareness turns stability from an assumption into an informed choice. Stablecoins have transformed the crypto ecosystem and are moving closer to mainstream finance. However, their promise of stability hides serious vulnerabilities. Reserve opacity, liquidity stress, and depegging risks make them far more fragile than many believe. As their role grows, so does their potential to cause systemic damage. The future of stablecoins depends on stronger transparency, smarter regulation, and better user awareness. Ignoring these risks could lead to sudden shocks with wide-ranging consequences. Stability must be built, not assumed. That was all for today's video. Share the video with your friends. Don't forget to subscribe to our channel now and hit the bell icon for regular updates. Thanks for watching. Have a wonderful day.